You're likely to have the cut in October and another one in December as the market is pricing in. He didn't give you too much beyond that. He's not committing too much beyond that. So it tells you that the trajectory stays on the front end of the curve. Longer rates, it's a little bit questionable. You have a lot of issues out there, maybe as it relates to tariffs and maybe future inflation that you have to consider. You have to consider maybe fiscal policies and the effect of that on in the U.S. Salt is coming off. A lot of money is going to be coming back into the U.S. market from the salt tax cut, call it. And then you have to consider U.S. debt and the growth of U.S. debt. So all of these things that I think are putting pressure on the longer end of the curve. So maybe yields don't come down as much in the longer end as they maybe would do in the front end with the price of the current cuts.
The way the curve is not so much shape, but the way that it's moving, right? Folks in your world basically call that bull steepening. So you're looking for that to continue then, in other words?
Yeah, we think so. We think the environment is really set for that. There is a lot of uncertainty in the long end, again, as we just discussed, that I think keeps that pressure on there. So, and in the front end, I mean, rates will come down. You will have those cuts. So I think a bull steepening positioning makes a lot of sense for us. Okay,
does going long duration make sense right now?
It does. I could tell you that we are long duration, not massively, but we do have a small long duration position on, but we're really concentrated more on the front end of the curve and the belly of the curve, with avoiding the longer end of the curve, 10 and 30-year bonds. Okay. That's where we tend to be underweight.
All right, yeah, I've been hearing that a lot as well, preference for the belly of the curve. Chair Powell also talked about quantitative tightening, QT, saying, look, they're almost at the end of the road, shrinking the Fed's balance sheet. We're down from 9 plus to about a little over 6 right now. What could that potentially mean for yields?
I mean, the process has been going on for a while, and I think now they need to pull back a little bit to see if they've reached the goal that they wanted to reach. And he definitely indicated that last night or yesterday. So I think it kind of shifts the focus back on monetary policy, direct monetary policy, and rate cuts and how that's going to affect the economy versus, call it, the supply of bonds in and out of the market from the Fed. They're trying to pull away from that end and just focus on the actual monetary policy.
So in terms of supply, what I found fascinating is, Secretary Bessent basically inherited a situation that started back during Janet Yellen's days, right? Issuance very much at the short end of the curve. And folks have been at least initially thinking that he may want to term out issuance, right? Move it over further to the right. That hasn't happened yet, and there's a reason for that. And I want to get your take, and I'll leave you to navigate so you don't get into trouble yourself, right? But the reason there's so much pressure on the Fed, and the reason that issuance has been still choked up at the short end, is because they want to bring down the cost of financing U.S. debt.
Oh, absolutely. I mean, this is very clear. They don't want to commit lock-in rates that are higher and not sustainable in terms of financing the debt. Yeah. The idea of debt sustainability at 5+% in many developed countries is just not really feasible. Yeah. You need to bring those rates down before you kind of commit to extending your duration and fund your debt with longer dated maturities. So until that happens, I think they will continue to focus on the front end of the curve. So it might be a while before they do that extension.
All right. Let's go a little bit further out the curve and talk about demand for one thing. We just talked about the supply, but demand. The indirect bid, which I'm sure you follow very closely, right? It's sort of the usual suspects. There's China, there's Japan, and I think over the last year or so, the UK has crept up there for a couple of months, right? What does that say to you about appetite for treasuries?
Well, it's still there. At least from a lot of the official channels. You can see that it's definitely still there. So the demand for that supply is still there. At a certain yield level, there are buyers. So I think that's going to be the case still. I think where you see it less is more from a retail perspective and from just investors' perspective. They're a little bit more weary about what's happening in the long end and fixed income, long-dated fixed income in general, especially with more tight credit spreads in multiple markets. They're a little bit more careful going across the curve, whether it's in treasuries or in credit products.